The party is over. The roar of the crypto bull run has faded into an uneasy silence. The meme coins have returned to the ether, and multi-million-dollar JPEGs of apes are gathering digital dust. For many, this is the graveyard of hype, a brutal hangover from a speculative frenzy. But while the world was distracted by the noise, a different kind of revolution began. Not with a bang, but with a whisper. In the boardrooms of BlackRock, JP Morgan, and Goldman, the very titans of the old financial world that crypto promised to overthrow, a plan was set in motion. A plan to build a bridge, a trillion-dollar bridge that could change everything we thought we knew about finance, ownership, and the very future of crypto itself. Look, before we dive in, let's get one thing straight. I am not your financial advisor. This isn't a signal to ape into the next hot RWA coin. My job here is to connect the dots, to dissect the tectonic shift that's happening right under our noses. This video is for your brain, not your wallet. Think of it as educational ammunition for the next time someone tells you crypto is just a fad. Today, we're going on a deep dive into real-world asset tokenization. First, we'll expose what this revolution actually is, and I promise to explain it so simply you could teach it to your grandma. Then, we'll uncover why the giants of Wall Street are suddenly pouring billions into this space. After that, we'll explore the mind-boggling market predictions. And yes, we are talking trillions of dollars. But this isn't a hype piece. We will also confront the dark side, the massive regulatory, technical, and philosophical hurdles that could bring this whole experiment crashing down. And finally, we'll ask the big question. Is this the moment crypto finally grows up? Or is it just the next, more sophisticated bubble waiting to pop? You'll decide. So what on earth is a real-world asset, or RWA? It's exactly what it sounds like. Any asset that exists in the physical world outside of the blockchain. Think real estate, fine art, gold, private company shares, even streams of income like music royalties. These are assets that have tangible, verifiable value, but they've always had one huge problem. They are painfully illiquid. Let's use an analogy. Imagine you own a rare multi-million-dollar collection of original vinyl records. It's incredibly valuable, but it's stuck in your basement. You can't easily sell a tiny piece of one record, and shipping them across the world is a logistical nightmare. That collection is an illiquid asset. Now, what if you could create a digital playlist of that collection on Spotify? Each song is a digital token. You still own the physical records, safely stored, but now you can sell fractional shares in your playlist, let people from all over the world stream individual songs for a fee, and trade ownership of those songs instantly, 24/7. That is RWA tokenization. It's the process of creating a digital twin of a real-world item on a blockchain. That deed to your house, a paper in a filing cabinet? Tokenization can turn it into 1,000 digital shares that can be traded on a global market. This process is powered by smart contracts, self-executing agreements that automate everything from dividend payments to ownership transfers, all without a middleman. But how does the blockchain, a closed digital world, know the real-world value of that house or the interest rate on a bond? That's where a critical and potentially vulnerable piece of technology comes in: oracles. Think of oracles like Chainlink as secure data couriers that fetch, verify, and deliver real-world information to the blockchain. Without them, the digital token is just flying blind. Remember that term, oracles, because they are the magic and the potential Achilles heel of this entire system. For years, Wall Street scoffed at crypto. They called it rat poison squared and a tool for criminals. So why the sudden change of heart? Why are they now leading the charge? The answer is simple: efficiency and money. Trillions of it. Larry Fink, the CEO of BlackRock, the largest asset manager on the planet with over $10 trillion under management, put it bluntly. He said, the next generation for markets, the next generation for securities will be tokenization. This isn't just talk. In 2024, BlackRock launched its first tokenized fund, BUIDL, which tokenizes US Treasury bills. In its first year, it exploded past $1 billion in assets. Franklin Templeton, another giant, has a tokenized money market fund managing over $300 million. JP Morgan's OwnX platform is already processing $1 billion in daily repo transactions
using blockchain technology. These aren't experiments. This is the new infrastructure being built.
So what's the prize they're all chasing? First, unlocking trapped capital. The Boston Consulting Group estimates that the market for tokenized illiquid assets alone could reach a staggering $16 trillion by 2030. These are assets like real estate and private equity that are currently locked away, inaccessible to most. Tokenization puts them in play. Second, radical efficiency. In traditional finance, settling a trade can take days, known as T+2. This ties up billions of dollars in limbo. Larry Fink highlights this perfectly, noting that with tokenization, transactions that currently take days would clear in seconds, and billions of dollars currently immobilized by settlement delays could be reinvested immediately back into the economy, generating more growth. This isn't just about saving a few bucks on fees. Blockchain could cut administrative costs by 50 to 70%. It's about increasing the velocity of capital for the entire global economy. And for the crypto world, for DeFi, this is a game changer. DeFi has long been criticized for being a volatile, self-referential casino where yields are generated from speculative tokens. RWAs provide a solution: stable, predictable yields backed by real economic activity. We're talking 4 to 5% from tokenized treasuries or 8 to 10% from private credit. This is how DeFi matures. It's the shift from FOMO to fundamentals. The numbers being projected by some of the most conservative institutions on Earth are hard to wrap your head around. They are so astronomical, they sound like science fiction. Let's run through them. Boston Consulting Group and ADDX project the market for tokenized illiquid assets to hit $16 trillion by 2030. Citi's forecast is even more ambitious: $4 to $5 trillion by 2030, with a potential surge to $18 trillion by 2033. A recent report from BCG and Ripple suggests the market could reach nearly $19 trillion by 2033. Even a conservative estimate from McKinsey places the market at $2 trillion by 2030, with a bullish case hitting $4 trillion. To put that in perspective, the entire market capitalization of gold is around $14 trillion. The entire crypto market at its absolute peak was just over $3 trillion. We are talking about a potential market that could dwarf everything that has come before it. These institutions believe tokenization will sweep across every asset class. Real estate projected to be between $5 and $8 trillion by 2030. Debt and fixed income, $4 to $6 trillion. Even private equity at $1 to $2 trillion. The sheer scale of these numbers implies a fundamental rewiring of our financial infrastructure. But as with any revolution, the path forward is paved with obstacles. This all sounds inevitable, right? A clean, straight line to a tokenized future. But the reality is far messier. The tokenization revolution faces a minefield of challenges, and any one of them could cripple its progress. First, and most importantly, is the regulatory maze. The laws governing assets were written a century ago for a world of paper certificates and handshakes. How do you apply them to a token on a global borderless ledger? The Howey test in the US, which determines if something is a security, is a legal minefield. Regulations are a fragmented patchwork across jurisdictions, creating massive uncertainty for issuers and investors. This isn't a small problem. It is arguably the single largest impediment to mainstream adoption. Second is the technical minefield. Smart contracts are powerful, but they are also brittle. A single bug or exploit in the code can lead to catastrophic financial losses, as we've seen countless times in DeFi hacks. And then there's the oracle problem we mentioned earlier. If the oracle is manipulated or feeds bad data to the blockchain, the entire system breaks down. The on-chain token becomes worthless, regardless of the blockchain's security. The system is only as strong as its weakest link to the real world. But perhaps the most profound challenge is the centralization paradox. Crypto's founding ethos was decentralization, removing the need for trusted intermediaries. But RWA tokenization, by its very nature, reintroduces them. You need a centralized custodian to guard the physical asset. You need lawyers to structure the legal claim. You need an issuer to mint the token. This creates a hybrid trust model. It means your on-chain token is ultimately reliant on the competence and integrity of these off-chain entities. What happens if the custodian goes bankrupt? What if there's a legal dispute over the physical asset? The clean, trustless world of code collides with the messy, unpredictable world of human institutions. This introduces old-world counterparty risks that crypto was supposed to eliminate. So here we are, at a crossroads. On one hand, we have the promise of a truly global, efficient, and accessible financial system. A future where trillions in trapped value are unlocked, where ownership is fractionalized, and where markets operate 24/7 with near-instant settlement. This is the vision of RWA tokenization, a bridge that allows the innovation of DeFi to finally merge with the scale and stability of traditional finance. But on the other hand, we face the risk of a sanitized, centralized version of crypto co-opted by the institutions it once sought to disrupt. A future where the core principles of decentralization are traded away for institutional buy-in, creating a system that inherits the risks of both the old and new financial worlds. So, are we witnessing the birth of a new trillion-dollar financial paradigm, or is Wall Street simply putting a new crypto skin on the same old game? Is RWA the bridge to a more democratic financial future, or is it a Trojan horse that lets the old guard take over for good? The pieces are on the board, but the game is far from over. This is not a fleeting trend. It is a paradigm shift, and now you understand the stakes. The real question is, what happens next? I want to know what you think. Is RWA the inevitable future of finance, or is it a centralized trap? Let me know in the comments below. Let's get the discussion going. And if you want to stay ahead of the curve on the biggest shifts in finance and technology, and you enjoyed this deep dive, make sure you hit that like button and subscribe for more content just like this. Thanks for watching.